So I don't know. I mean, you've made a lot of money this year by basically doing the following, which is the exact opposite of everybody else. When everybody else was freaking out, had you bought, you would have made a ton of money. Now everybody's like, it's over. And you can tell that by looking at the VIX, which is the volatility index.
Hey guys, welcome back to the channel. Today we have Chamath on the All In podcast talking about the future of the finance industry. Chamath believes that it's important to take both sides of an argument and intellectually reason why each side could be right. People might be saying that the Fed will yield by early 2023, and there is a clear expectation that rate increases will have to occur. The other side of the argument begins with plenty of energy, which Chamath thinks is essential since it leads to the convergence of political and economic systems. Chamath says the best way to make tons of money this year is to check out the volatility index, which is currently in the teens, and this means buying short stocks. Let's listen to Chamath on the All In podcast as he talks about the CPI rates and how to combat inflation in the current market. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
I think at the time, initially, I think I said, it rallies to around 4,000. I was a little off.
What rallies to 4,000?
The S&P.
Yeah.
Probably gets to 4,200, 4,300. Look, it's always important from my
perspective. Trading at 4,150 today, just so people know.
Yeah, it's always important from my perspective to just take the other side and just intellectually debate with oneself why the other side could be right. So at this point right now, what people would say is, okay, the Fed's going to capitulate at the beginning part of 2023. We have a pretty clear forecast for all the rate increases that have to happen. Everybody's doing the work that's necessary, either raising prices, cutting costs, or doing both, letting people go, et cetera, et cetera. So maybe we're there. But what's the other side of that? Well, I think, again, as I've stated before, the other side starts with energy. And the reason why I think it's important is that it really is the conflation of an economic system and a political system using an instrument.
Chamath notes that the demand for oil has gone down because OPEC thought they could increase barrels to 600,000 per day, which only 2 countries have been able to accomplish successfully. Chamath has never seen a time in American history when the CPI is printed higher than 5% without Fed funds rising to the same amount. Chamath hopes this is just the expectation that proves the rule, but a gigantic amount of data tells us we need to double the rates of what is believed to be the current equilibrium.
We're about to get into the high teens. You have systematically, it has been true that when the VIX is in the teens, you tend to basically buy volatility, which is essentially you get short stocks. And when the VIX is in the 30s, you tend to basically sell volatility and you buy equities because we've hit the bottom. If you've been doing that for the last year, you've made a ton of money. So there you have it. I really don't know what's going to happen from here, but I tend to think things still have to get a lot worse to flush everything through the system.
If you look at oil, Sachs, we are now down to $87 for a barrel. Haven't been here since, looks like, February maybe. And gas prices plummeting. Something going well in this regard? What are your thoughts?
There's less demand. The crazy sad thing about this whole thing with Biden was that OPEC came back and they basically said we can increase like 600,000 barrels a day. But the only 2 countries that are able to do it were, I think, Kuwait and Saudi. And the total number of barrels is about 100,000. So with all the bluster and all of this stuff,
you're right. Actually,
there's no supply.
It's because the interest rate increases are actually having an effect.
Correct. You would agree they seem to be doing something correct here with the 75 bips, and taking it a little more seriously. It's having an impact.
I'll say it again. I've said it now 5 pods in a row. We've never seen a moment in history, in American history, where when CPI has printed successively above 5%, that it got under 5% without Fed funds getting to that same number. So we should all hope that this is the exception that proves the rule, but there's an enormous amount of data that would tell you that we have to take rates to double what the equilibrium rate is thought to be right now. There's always stuff going on in markets, and markets represent the collective sum of our wishes and expectations and also the realities. This is why I think for me, at least, the way that I process this information is not trying to have an opinion on any one of those things, because I find it too hard. And I don't have enough depth of understanding of any of those things. For me, I'd rather go back to the historical trends, because those I find a little bit easier to parse. And whether any of those things are true. So the real problem is that, like, if I go back to the historical artifacts, have there been issues in the past the way that, Friedberg described? Absolutely. So this is why I think you can look at the fact that whenever there's inflation and whenever it's spiked, what has had to happen by the Fed is you have to take rates above that key 5% threshold when CPI is above 5% to break enough demand so that the economy's reset. And I think that's where we are. So instead of trying to figure out whether, the Brazil thing as an example that Friedberg said is crazy. Like, he's basically, he said publicly in a press release, the army's on my side and it's ready to help me, keep and stay in. Like, just the craziest thing. So what are you supposed to do?
The fighters need to take to the streets. It's like,
so what are you supposed to do? In my opinion, I'm like, you know what? A version of Brazil has happened before. I don't know enough history, quite honestly, to know the specifics of what happened then and how that could translate to now. And I don't want to spend the time understanding what's going to happen in Brazil right now. I'd rather just say there are 20 or 30 things that could very much complicate the world economy. I think the reality is that governments need to flush all this excess money out of the system so that we can really find out what equilibrium demand is and get back to normal. That era of cheaper, faster, better is over. And what comes with that is better national security, but the cost of that better national security is higher prices.
Higher prices, less growth.
And there's nothing that we can do to avoid that. I'm not sure I agree with the less growth. I actually think that there's enough excess slack to be absorbed by all of this free money that I think you can still have sustained growth, but it will come with higher interest rates and higher inflation and higher input costs. Everybody will have to do their part to absorb some of this, but that's what's going to happen. And I think we should just deal with the medicine as quickly as possible. This is why the people that actually think that the Fed should just be very aggressive and get this over with quickly, I suspect on the margins are right. The problem is they don't want to look at the historical artifact, because the historical artifact would say, wait, I need to raise interest rates by another 250 basis points. That's just way too disruptive for what the world is ready to hear right now. So we're going to incrementally plot along. And I think what Friedberg says is right, which is that there's going to be a whack-a-mole that emerges. That's going to tilt the markets. Then the consumer credit thing will implode. That's going to tilt the markets. Then Jair Bolsonaro will try to take over Brazil. That'll tilt the markets. And we'll go back to this, inflationary, fragmented, deglobalized view of the world that just frankly takes higher interest rates to normalize.
Chamath states that when inflation occurs, the Fed must take rates above the central 5% threshold when the CPI is higher than 5% to break adequate demand and the economy can be restarted. The government needs to remove all surplus money from the system to discover what the equilibrium demand is so everything can return to normal. Chamath believes the period of faster, cheaper, better is finished. This means better national security, but higher prices. Chamath believes we can still have perpetual growth, even though it will mean higher input cost, inflation, and interest rates. Everybody will need to lend a hand in helping to decrease the effect of the increased expenses. What do you guys think of Chamath's prediction for the financial market? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.